This morning's presentations and yesterday's to me were very erudite, and there's so much related to this issue in terms of policy, in terms of technology, in terms of financial stability and supervision. None of that I'm going to deal with because it's been dealt with by everybody else so well and so deeply. I'm dealing with a simpler topic, which is money laundering, and that's basically about risk, vulnerabilities, and implementation of the standards of the FATF in particular, and how that might affect or does affect other aspects of supervision and other aspects of government policy. So having said that, let me just move on here. I'll give you three little parts of my presentation. One is what the FATF's view was some years ago. Secondly, what it is now. And thirdly, whether or not the proposed changes to the standard in relation to virtual assets, as the terminology used by the FATF, is actually likely to work or not. And to be honest, I have my doubts. So the FATF standards were revised, and I had a big part in revision of them in 2012. They began to look at virtual currencies, as it was called then, and definitions in 2014. And in 2015, they started to look more seriously at what guidance might be required. And this guidance is basically aimed from a very limited perspective of whether or not crypto assets or cryptocurrencies, as then mentioned, and the terminology is confusing, overlapping, ambiguous, and sometimes needs readjustment, and will do so, I think, in the future. But for now, the FATF is calling it virtual assets. So, but in those days, in 2015, it was mainly looked at as an issue that was another form of money, only in digital form, and therefore all the rules that applied to transactions of a traditional nature need to be covered by the FATF standards in terms of virtual assets as well. So the key recommendations in 2015 that came out of the FATF's guidance paper, as mentioned on the screen, countries should decide to regulate exchange platforms between convertible virtual currencies and fiat currencies. That is, convertible virtual currency exchangers. Excuse me. Countries could decide to prohibit virtual currency activities. However, they should take into account the impact a prohibition would have on the local and global level of money laundering and terrorist financing risks. In other words, would you drive it underground? You'll see that there is at this stage no indication of a recognition that the issue of whether or not digital ledger technology is a good thing or a bad thing. It's just about the transactions. And that position has obviously matured, and I'll come to that in a minute, because now the view is that new technologies, which I'll describe shortly, as well as crypto technology, need to be guarded against issues such as banning them altogether. Some countries can, by their sovereign nature, of course, can choose to do that, but the limiting of innovation is now one of the implicit standards of the FATF, if I can put it like that. So in terms of what else came out of this early guidance, registration or licensing requirements of Recommendation 14 should apply to domestic entities providing convertible virtual currency exchange services between virtual currency and fiat currency. And there was a lot of discussion in the last 2 days about that. That's now changed. I'll come to that as well. And countries should ensure that when convertible virtual currency exchanges conduct convertible virtual currency transfers that are wire transfers, they include required originator and beneficiary information specified by Recommendation 16 of the FATF standards. This is a very important point because essentially the standards that are being discussed at the moment by the FATF in terms of what should become governable, if I can use that term, moves to a situation where essentially they're still treating this type of currency or asset in terms of it being similar to a wire transfer. And there are some difficulties, in my view, about whether that will in fact work. So, in terms of the expansion from virtual currencies to virtual assets, they rethought the position, essentially, and looked at, between those 2015 and 2018, they recognized that virtual currencies space had evolved into and included a range of new products and services, business models and activities, which meant that the previous narrow focus on virtual cryptocurrencies required updating. Just to put you in the picture, how many of you are familiar with the three relevant FATF recommendations here? Recommendation 14, 15 and 16. Who is not familiar with that? Okay, lots of people. Okay, let me just summarize those because it will put you in the picture as to whether or not what we're talking about makes sense. Recommendation 14 is about money or value transfer services, MVTS. And in 2015, 16, 17, the standards were applicable to those kinds of services. In other words, transactions that go cross-border using wire transfer type services. And this is connected to the issue that I mentioned earlier about wire transfers. So what does that mean? Recommendation 14 requires natural or legal persons that provide money, money or value transfer services to be required to be licensed or registered. Countries should take action with a view to identifying natural or legal persons. MVTS providers should be subject to monitoring and all AML CFT compliance requirements, etc. Recommendation 15 is about new technologies. Countries and financial institutions should identify and assess the money laundering risks that may arise in relation to the development of new products and new business practices, including new delivery mechanisms, so that we're keeping their options open for new developments, which we now are at in terms of crypto. And the use of new or developing technologies for both pre-existing products and new products. The issue of products, if I may just give you a personal view at the moment, I've been talking to many business players in this space, and the number of products that are coming up are mind-boggling, the sheer scale, the sheer use of them. And one of the clear difficulties I think that a standard setter will face, and compliance officers and financial institutions will face, is, and regulators too for that matter, is keeping up with the pace of the types of products that are available and how those products fall into or not into the current definitions of virtual assets. Frankly, I think that we're way behind the play in terms of what the market is doing. And we need to have a much more joined up, and I think this is the type of terminology that was used yesterday to some degree, needs to be done, because if we don't do that, then the silos will continue. Everyone will try to do their level best to meet what is a very evolving and quickly evolving area, but they will not come out with a common solution. And I'm assuming there is a common solution. I'll come back to that point. So with new technologies, the standards say financial institutions should be required to undertake a risk assessment prior to the launch of or use of such products, practices and technologies. And secondly, take appropriate measures to manage and mitigate the risks. That sounds like two very small sentences, but the work involved in doing that is immense. And frankly, with the number of different types of products that are now being used, that is a very, very big ask. The third and last recommendation that's relevant to give you a picture of what the standards are looking at and require, it relates to wire transfers. This one is too long to read out to you, so I'll just summarize some of it. There are 18 subcategorizations of paragraphs in relation to wire transfers, but essentially financial institutions should be required to ensure that all cross-border wire transfers of above $1,000 US or euros are always accompanied by the following information. The name of the originator account number where such an account is used to process the transaction, or in the absence of an account, a unique transaction reference number which permits traceability of the transaction. If you're using SWIFT, that's okay, you'll find it. But if you're not, it's not okay. Secondly, the originator's address or national identity number or customer identification number or date and place of birth. Again, leaving aside privacy issues for a moment, that is achievable by financial institutions, but in terms of virtual asset exchanges, they won't always know or be able to find out that information. Again, leaving aside the confidentiality or privacy concerns. Next, in terms of wire transfers, there's a requirement for beneficiary information, the name of the beneficiary, and the beneficiary account number, where such an account is used to process the transactions, or in its absence, a unique transaction reference number which permits traceability of the transaction. So that's the background to what the current standards say. And it raises a number of issues as whether that's in fact achievable. So let me just continue. Here on the screen you will see at one of the items there, as a result of a 2018 discussion between the FATF and the private sector and internal discussions, virtual currency space discussion evolved. And in particular, we saw the rise, and this is one of the issues for money laundering, because remember that this is not so much about policy, even though the standard setter is a policy maker. It is about, can we manage and mitigate the risks of any product which facilitates transactions where you may have difficulty knowing who the customer is or conducting customer due diligence appropriately. So one of the issues that they took into account was the rise of anonymity-enhanced cryptocurrencies. There's actually an acronym for that, AEC. I didn't know that until recently. Such as mixers and tumblers, decentralized platforms and exchanges, and other types of products and services that enable or allow for reduced transparency and increased obfuscation of financial flows, as well as the emergence of other virtual asset business models, such as initial coin offerings that also present money laundering risks, not the same ones, in addition to fraud and market manipulation risks. So those are some of the risk side that the FATF took into account, and as a result of that and other considerations, in October they adopted, 2018, a new glossary definition that virtual assets and virtual asset service providers, as has been described earlier in one of the panels, and updated recommendation 15 in order to further clarify the application of the standards to virtual asset activities and to virtual asset service providers to assist jurisdictions in mitigating those risks. So the key changes arising out of that are the following. Definition of virtual assets is significantly expanded with, I think, unclear consequences. Almost everything has a value, almost everything can be transferred, and almost everything can be a payment. The definition could inadvertently capture a host of unintended uses, including fractional property interest. There was a mention of that yesterday, artworks, in-game tokens, even tickets, which is just a few examples of what that broad definition might cover. Hopefully, good sense and sanity will prevail, but in an area where we are often dealing with precision, it is not precise enough, in my view. Secondly, clarification that the FATF standards apply to both virtual to virtual and virtual to fiat transactions is now part of the standard. And thirdly, virtual asset service providers now include more than just the virtual asset exchangers. It also includes certain virtual asset wallet providers, custodial service providers, and providers of financial services relating to the issuance, offer, or sale of virtual assets such as ICOs. So you will see that in struggling with how to avoid the effect on innovation, the FATF is at the moment, I think, a little bit sitting on the fence in terms of This is not to put down my former organization. I have a great deal of affection for it and for the work that it's trying to do. But I'll come in a minute to tell you why I think it's not going to work as effectively as the current proposals suggest. So in terms of the shift from voluntary risk-based regulation to mandatory obligations, I mentioned that recommendation 15, that's the one about new technologies, was amended. So that now requires licensing or registration by countries at a minimum, and to license or register virtual asset service providers in a jurisdiction which they're created, and where a VASP is a natural person, they must be licensed or registered in that jurisdiction where business is being conducted. Countries also may choose to regulate VASPs that offer products and services to customers or conduct operations from their own jurisdictions, and sanctions apply if they carry out activities without being licensed or registered. For those of you who are not familiar with the money laundering space, the word recommendations here means standards. It doesn't mean it's discretionary. It means that it's compulsory. Because compulsory in the sense that the FATF has no international sovereign legal authority to do anything, but its members do. So at a national level, once they, in consensus in the FATF plenaries, decide what the standards are, then they are obliged to themselves live up with those standards and oblige everybody else to do the same, to put it in simplistic terms. Secondly, in terms of recommendation 15, supervision. VASPs must be monitored or supervised by a competent authority and not be a self-regulatory body. Some bodies are allowed to be self-regulatory in some countries, such as lawyers in a few countries and accountants in a few others, but I won't dwell on that. It also requires dealing with occasional transactions. Usually the anti-money laundering requirements concentrate, as you would expect, on regular transactions, what the parameters of a customer, of a bank customer's transactions are. Know your customer considerations depend on knowing what their normal transactions are, and if they're abnormal, they get reported to a financial intelligence unit, whereas occasional transactions, which are one-offs often, are not dealt with very much, except in a couple of instances, and this is one of them. In terms of VASPs, because the risk is considered to be generally high, even though one, after digging down, may find that it's not high if you do a proper risk assessment, as is required, occasional transactions are required. So customer due diligence needs to be done for occasional transactions above $1,000 or 1,000 euros. And what I mean by that, again, for those who don't know, customer due diligence is a very in-depth profiling, using a bad word, but identification of what a customer is, where their money came from, what associates they may have, whether there are any suspicions or unusual activity, and many other parameters that are looked at. And then wire transfers, as I mentioned before. Recommendation 15 now requires originating virtual asset service providers, those who provide the service originally, need to do certain things. Obtain and hold required and accurate originator information and required beneficiary information on the transfers. Second, immediately and securely submit the information to the beneficiary VASP or other financial institution. Thirdly, make the information available to competent authorities on request. And finally, beneficial VASPs must obtain and hold required originator information and beneficiary information transfers and make that information available to competent authorities on request. There seems to be a little overlap there, but I've read that quickly. The main point here is that when I've spoken to a lot of people in the industry who do provide money service businesses using DLT, blockchain technology, they say that that is not workable. They say that the VASP or the exchanges may not know and probably will never know who the ultimate beneficiary is, or even who the ultimate person is who is transferring the funds. So there's a fundamental question there as to whether that application of the standard as it currently is will work in practice. I note that the standard and the new guidance that's expected by the end of June to be approved will have with it a one-year review period, so that a year after it comes into effect, assuming it does come into effect in June, there will need to be, they've decided there will need to be a review of the new standard and its implementation, progress or otherwise. Frankly, I think that's going to be inevitable. So, this slide concerns some issues and questions that are still to be determined. So let me just run through a few of those points. The term virtual asset now covers any transferable asset that is used for payment or investment purposes, whether financial or non-financial. And that could cover a host of other uses, including, as I said, fractional interest in collectibles or property and other things. And it adds complication because the fact that tokenization now allows consumers to hold an interest via digital token on a blockchain in a real-world asset, that is not necessarily a financial or monetary instrument that may have some value. So how do you determine whether it has value? How do you determine whether or not it should, in fact, be considered under that description as part of the requirement? Secondly, there's a risk of peer-to-peer usage. In other words, driving the industry underground. If we over-regulate VASPs, it'll encourage users to engage in peer-to-peer transfers via non-custodial wallets, which are much harder for law enforcement to track and control. This is the essential underlying aim of money laundering detection in the first place. There are preventive measures, but obviously preventive measures can be overcome by criminals, especially clever ones. And what happens then? The standards apply to enforcement measures. So as in the old days when people hid cash or hid it by buying assets, the same principle applies here. How do the law enforcement agencies get access to information if they're conducting a valid investigation of a crime or the proceeds of a crime and the money laundering that might be associated with that? They rely on information from financial institutions, apart from the classical detection methods that police have with informers or with information gathering from other sources. But in the money laundering space, they are highly dependent on information from the primary holder of information, which is financial institutions. And financial institutions' role is becoming more one of helping to assist investigators obtain that information. When I was in this work many years ago, we used to say to police and we used to say to financial institutions, banks in particular, who were opposed to the whole idea of being burdened with anti-money laundering controls at that time, that you don't have to be a police officer. You only have to report suspicious transactions. Well, those days are gone. They still don't have to be police officers, but the need for a much more sophisticated exchange of information mechanism is now an implicit part of the process. And for those of you who may be interested, there are experiments around the world now in about 10 jurisdictions where there are task forces, such as in the UK called JMLIT, Joint Money Laundering Investigation Task Forces, which bring together law enforcement agents and compliance officers from financial institutions and banks. The same thing is the same experiment is being replicated in many other countries, about 10 or 11 to my last count. And why is that? Because the value of information from suspicious transaction reports, the reports that banks put into the Financial Intelligence Unit when they come across unusual or suspicious transactions, can be leveraged much more, with much greater effect if those who know who the client is and their pattern of banking or any suspicions they have can be brought into the discussion at an earlier stage as opposed to evidence gathering after a charge has been made. So that's the basis of the whole exercise in terms of information availability and information sharing, under law, of course. And I think in this space with virtual assets, the level of, how should I say, awareness or skill sets for law enforcement agencies, with all due respect, it's early days in this space, things are evolving rapidly, is very low. And without the ability to build up a level of trusted cooperation between financial institutions who have reporting obligations on the one hand and law enforcement agencies on the other, I see the problem getting worse and worse as more sophisticated methods of transferring assets or wealth, or however one wants to describe it, on digital platforms. So the technological impediments issue to implementing the wire transfer requirements, there's really no way to determine if a virtual wallet is located in the jurisdiction. For example, a domestic transfer, or overseas if it's a cross-border transfer. But the FATF has decided to apply the cross-border requirements in Recommendation 16, the wire transfer one, to all virtual asset transfers. I think they have done that because to do otherwise would not deal with the view that the risk is high, as opposed to, at the moment, having a sufficient grasp of what the risks are to determine that the risk may be moderate or low in some instances, and hence we need that circle of determining whether a particular product or particular usage is high, medium or low risk, to use my own simplified terminology. And I think setting it all at that level, where all virtual asset transfers have to be reported, is going to be a very challenging one, and I'm not sure it's going to produce the result that's required. But as I mentioned a little earlier, the FATF does conduct outreach to the private sector. It does do so in a number of ways, one of which is the Private Sector Consultative Forum mechanism. They had one of those meetings not so long ago. I've forgotten the date now. I think you were there, weren't you, Elizabeth, at that meeting? When was it? I forgot. Yeah, May. Yeah, not so long ago. In that meeting, I think there was a difference of opinion from what I hear from people from the private sector and from the FATF. Industry was divided on the question of whether or not the development of a messaging protocol similar to SWIFT for wire transfers was even technically feasible. If you've got, you all know what SWIFT is, right? An identification number that follows a transaction that you send by wire so that you know from whom and to whom it's gone. That is a basis under which the FATF seems to be currently relying in terms of applying a wire-like transfer requirement to this space. And I think that from what I've heard from people who run money service businesses using DLT, apart from perhaps some major banks, they feel that they will not be able to technically do it. So that immediately raises the question of should the standard remain as it now is going to be, or should it be reviewed again? And as I mentioned, it should be reviewed again. I think sooner than a year is my own suggestion. See, by implication, if we're talking about originating virtual asset service providers, if they don't know whether the address is owned by a VASP or a non-VSAP or a natural person, that has huge implications for the anti-money laundering rules. There are other aspects too that are not yet understandable. Storing data on a public blockchain, for example, is likely to be incompatible with data privacy legislation. We have somebody in the room, I think, from the Data Privacy European regulator, might want to make a comment on that. But the EU General Data Protection Regulation will run up against that requirement if that information is going to be stored on a public blockchain. As far as I can see for the moment, the anti-money laundering rules have to some degree taken precedence over the privacy rules when it deals with, as it does, criminality. But it still means that the privacy rules have to be abided by to a very large degree. The last point here is storing data in a centralized cloud-based register accessible to virtual asset service providers has risks of what some people are calling a honeypot risk for hackers. If you store information like this in a cloud-based register, then it can be relative. I'm by far not a technical guy, but I'm told by people who are that the hacking possibilities increase a lot if that happens. So, where are we then? Interaction with the 5th Anti-Money Laundering Directive. I think that Oliver mentioned this a little earlier. So as you see on the screen there, the amendments have been put in place, but several important activities are at cross purposes, I think. For example, the FATF's amendments to Recommendation 15 will have some consequences for global regulatory frameworks, including the 5th AMLD. I think you mentioned before that one of them is going to be dealt with, touch wood, by the Commission, that the AMLD currently maintains the definition of virtual currencies rather than virtual assets. This limits the scope to more traditional type cryptocurrencies and doesn't cover the broader range of exchange security and utility type tokens that the FATF has in mind. So the terminological issue there is a difficult one. Well, maybe not difficult, but it can be resolved, but it needs to be resolved sooner rather than later, in my view. Again, the 5th Anti-Money Laundering Directive is limited to a number of things. Exchange services between fiat and crypto, and custodial wallet providers, that's cryptocurrency wallet services, where the provider holds its users' private keys. Importantly, it does not cover the transfer of virtual assets, and it does not cover the exchange. So those are areas that will also need to be somehow harmonized. Oliver, you mentioned something about that in your presentation earlier. Do you have some news about whether that's going to be revised sooner rather than later? Okay. So as of the beginning of this year, to give credit to the EBA, it highlighted the importance of ensuring that the EU-wide framework are expanded to meet the new standards of the FATF as well. And I take it that that's a common view in this room from a supervisory point of view. But it's still not clear exactly how or when that will happen. I do think, though, that it's going to be essential, to do so. Well, fortunately, that was the last slide because it went off the rails with me. So that's basically a summary of where things are at. And I think that in terms of what does that actually mean in practice, I think that industry is crying out for regulatory certainty. At the moment, generally speaking, industry doesn't think that the proposed coverage by the FATF, for the reasons I've just given, will work. And the main issue is implementation and enforcement for the government side. But from the industry side, it's whether or not two things are feasible. One is, will innovation be reduced? Two is, with the lack of ability by many innovators in this space to get financial institution support, banking or bank accounts, is a really big problem. I think I mentioned to a couple of people here that one was going to be here, but he didn't show up, Christopher. A young man who's 27. He started up a money service business using DLT technology to reduce the cost of remittance services for poor people in South America. He and his two friends have made $100 million out of that business. But to kids of that generation, the money doesn't seem to mean much. What means something to them is whether or not the innovation possibilities for doing good as opposed to just profitability is very high on the list. And he tells me that the current system will not be able to be technically done by them. They're having difficulties, despite the relative profitability and expansion of the business, in getting financial support from large banks, and that goes full circle to what are the risks? What level do the risks take? What kind of risk assessments or models exist currently in this space, whether that be within the financial institutions who are or are not prepared to take a risk in banking, virtual asset service providers, or the risk models that are being thought of but not necessarily yet in much use by regulators and supervisors around the world. So I think the evolving number of products, the evolving usage of this technology, and the way in which funds, money, value, or whatever the terminology one tends or wants to use in your own area of responsibility, comes down to just in terms of anti-money laundering, a couple of simple but difficult to achieve requirements. One is, can you know your customer? And two is, can you know enough about him to meet all the requirements of information reporting that is required under the current standards? Hopefully those two questions can be answered in a positive way, but I think at the present the jury is still out, and it needs a lot more discussion in a joined-up approach, not only between FATF members and regulators and supervisors, but I think also much more so with the private sector, financial institutions, and in particular compliance officers, anti-money laundering compliance officers in financial institutions, because they're the ones who are aware of both sides, the criminal suspicion potential or reality, and the needs of the business, of their business, financial institutions, to make profit. They're often the meat in the sandwich, or between a rock and a hard place, between the sales department on the one hand and the FATF requirements on the other, in terms of complying with the rules. But I've spoken now to literally hundreds of compliance officers around the world in relation to the crypto space and what they need to do about it. And for the most part, apart from a few financial institutions who've done very detailed studies of this issue, for the most part they throw their hands up and say, we don't know, because we're looking for a lead from the supervisors or the regulators. We're looking for a common way of approaching this, and wouldn't it be nice if we could all get in the same room to work out something that's both feasible practically, but also meets the requirements of what the standards require, which in terms of things such as money laundering, terrorist financing, proliferation financing, and sanctions evasion are very, very important issues. Most of you know money laundering and terrorist financing. The other two issues, just as a final word, I should say something about. Proliferation financing refers to the financing of weapons of mass destruction, not just atomic weapons, but other weapons, chemical weapons, etc. And the FATF standards now have moved into dealing more and more with that risk, and the requirements to report transactions for trade-based good, dual-use goods, etc., is an important one that the FATF is dealing with, but that brings with it consequential compliance requirements on not only financial institutions, but on other areas of commercial dealing, such as trade finance. And finally, the sanctions evasion, whether that be United Nations Security Council resolutions against certain countries or entities, or it be, in some cases, domestic designations of countries or individuals. They are also areas of compliance requirement by the FATF, and those four broad areas in terms of the crypto space, I think there is many potential holes in the system in terms of compliance understanding and compliance practice. So I'll leave it at that. Thank you.